Real estate investment practice problem using OneNote. Points break-even point with the help and use of pivot tables, part number 2. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 4210 Points Break-Even Point Pivot Table Part 2 tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're focusing in on the points calculation, the break-even point with relation to the points, this time using our pivot table types of calculations, which might make it a little bit easier to do these kinds of comparisons, noting that we do work this in Excel as well if you want to work through it in there, although we'll be spending more time with formatting and so on. And or if you think the Excel worksheet would be useful, we have the Excel worksheet on the answer key that you could use to do your own types of analyses. So our information, these are going to be the side-by-side comparison, comparing an item that has points and then an item that doesn't have points, remembering that points is generally the concepts of, they might say, you might hear it be called paying down the rate on the loan, in essence, putting more money up front. Prepaying, you could call it the interest, in order to get a lower interest rate, the primary objective often being to lower the payment amount to an appropriate payment amount that you think you're more likely to be able to pay, and or also have a net benefit possibly over the life of the loan in terms of the effective rate. So here we have our general information, the 200,000 home. We didn't put anything down just so you could just see the loan amount. So we're in essence starting with just a loan of the 200,000. The years are at 30 years, the months 360, 30 times 12. We have the rate starting out at the 5%, and then we're going to be adding the points. If we calculate it without the points, then we have the payment calculation on down below at the 1,073.64. On the right-hand side, we add the points. We're going to say 3 points here, remembering that the points represent 1% of the loan balance. So if we had the loan balance up top at the 200,000 at 1%, 0.01, we'd get 2,000. If we have 3 of those, then times 3, we get the 6,000. That's the cost of the points. That would be the upfront cost that we would be paying in order to get the pay down on the rate. We're assuming this time that the pay down is going to be the 0.25% pay down on the rate. That means that we have 3 of those, 0.25 times 3, or 0.75 minus the original rate of the 5%. So the trade-off being 6,000 up front in order to get that 5% down by the 0.75 to the 4.25, which lowers the payment to 983.88, which is the overall general objective oftentimes, but it can also have a benefit over the life of the loan. As we do the comparison, one comparison to see that would be the effective rate here, which would roll in basically the cost of the points into the effective rate. So the effective rate you can see is lower than the 5%. We're at the 4.508 over the life of the loan. Effective rate would be calculated with this formula on the right, which would be equal to the rate times the number of periods, which would be 360, and then the payment, not times, but the number of periods is the first argument, and then we have the payment, which would be negative of the payment, which would be here, the 983.88, comma, we have the present value, which is the little twist that comes into play here. It's not simply going to be the 200,000, but rather the 200,000 minus the upfront cost of the 6,000, because you could think of it basically we received 200,000 from the loan that we then used to buy the home. We didn't actually get it, but you can imagine that being the process. We get 200,000, then we paid it back to the seller for the home, and then we also had to pay $6,000 upfront to the finance company in order to pay the points up front at this point in time. So the net cash flow up front is actually the 200,000 minus the 6,000, even though when we look at the amortization schedule, the loan will be 200,000. So that's us trying to roll in the cost of those points resulting in that different rate, the effective rate. Now, as we do that, because we have this situation where we're now saying that the cost, basically the present value is kind of different because of that front loading than the amount on the amortization table, that's going to give us that timing difference over the life of the loan. So when we look at this side, that 4.508 then won't be constant through the life of the loan, as the 5% should be more constant through the life of the loan. And therefore, if there's going to be something that happens in the middle, say we sell the property and pay off the loan sometime in the middle, the question is, well, is that going to be beneficial or not if we're not looking at the entire life of the loan? Now, to consider that, usually last time we looked at the full amortization table and kind of hunted for the break even. There's two ways we can calculate it. We could think about what will be the break even in terms of a kind of a simple calculation on a cash flow basis, which doesn't fully take into consideration time value of money or the ending loan balance, kind of the effect on the ending balance as much. And then we could try to hunt around using our tool of the IRR. And that second method might be a little bit easier if we were to use pivot tables. You can use the same concept of using basically pivot tables in a similar fashion with other type of comparisons, which could give you a little bit easier method to do, although there's some approximations that would be involved with it. So here's the side-by-side amortization tables, both of them starting with the $200,000 upfront, even though the second one had the $6,000 paid, upfront on it. And then they're going to be calculating the payments using the two different payment calculations up top, which will have an impact on the ending balance and loan reduction as well. That ending balance amount is the one that often, or one component that's often not taken into consideration as fully when we do kind of our simplified break-even calculation, as we will see shortly. So if we scroll on down here, this is the full loan amount. They both zero out down at the bottom, of course, at the 360 or after the 30-year time frame. There it is. Then let's take a look at our pivot table. We can then add the pivot table if we so choose. We won't go into detail on how to do that because we've seen it in the past, but the general idea is we just insert the pivot table. We're going to have the years, which is going to be on this side in the rows column. Then we're just going to sum up the payment, the interest, the loan balance, those three, summing up the items per year, and then get the ending balance with regards to the minimum balance for the loan balance. If I scroll down to the bottom here, we'll see our two pivot tables, and this would be the two pivot tables that we can jump back and forth from as we update the data, going from adding points and not adding points in our data and then refreshing the pivot tables. Or we can just basically copy the pivot table after it has been refreshed. So we can see kind of a side-by-side type comparison, which would look like this then. And now we've summarized this data into 30-year time intervals. This is a lot easier to look at than if we were to look at an amortization table and try to analyze what's happening on basically a year-by-year basis. So we're kind of summarizing the data into a year-by-year breakdown. And so now we can see the sum of all the payments. So this $12,884, for example, would be the payment amount up top, which would be the 1073.64. That's rounded still, so times 12, because there might be more pennies or more half pennies over there. But in any case, it'd be about the 12,883.68 about, and this one's rounded again. So that gives us the sum of all the payments basically that are happening in that 1 year. The same for the interest, the loan balance reduction, and then the ending balance. So when we do our time value type of calculations based on this information, then it might be a little bit easier for us to do, although we're making some assumptions, some estimates on that, because we're using something like, if I'm looking at the cash flow of the 12,884, and I try to calculate that using like a time value calculation, such as an IRR calculation, this number is going to be represented as if the payments all happened at the end of the period, in that case, the end of the year. Obviously, they actually happened on 12 months inside the year, so it's not going to be quite as precise, but it'll be a lot easier to kind of go back and forth to look at a 30-period table as opposed to a 361. So there's some pros and cons to it. Let's see if we can get an idea of it in a little bit more depth here. If we've got the points break-even calculation. This is our standard kind of calculation, which doesn't take into consideration really time value of money so much and like the ending loan balance that's in place, but gives us a good kind of starting point as to where to look in terms of our balance, in terms of what the break-even will be. Remember that if we pay the money up front, if we're paying $6,000 up front, and then we're getting a benefit of this difference in the payments, then that if we have the loan for a shorter period of time, we're less likely for it to be beneficial. If we have the loan for a longer period of time, it's more likely to pan out as a benefit to us. But remember, there's two reasons we're kind of doing this, right? We just want to make sure that we get a low enough payment that we think we can handle, and even if we have a downturn or something like that. And then two, we would like it to be a net benefit, of course, over the life of the loan, if possible, as well. So it just really depends on what your goals are and how long you plan to be there, and so on and so forth. But we've got the $6,000. That's what it costs us up front. The difference in the payments, the payment without the points, if we didn't pay down the loan, if we didn't pay down the rate, then we would have $1,074. If we pay for the points, pay for the $6,000, we pay down the rate, which results in a lower payment of the $984. About, these numbers are rounded. So if we take the difference between those, that means we've got a difference per payment of $90. If there was $6,000 that we put up front and we're saving $90 every period, how many periods would it take to pick up that $6,000? It would take about 66 or about 67. If I took that 66 something and then I divided it by 12, we're talking about 5.56 on the years. So if we hold it longer than that, the idea being we're more likely for it to be a net benefit. Now, again, that's kind of an approximation, so we could try to use our IRR tools to be a little bit more accurate. When we look at our IRR tools, though, this time instead of going to the amortization table, which we did last time, meaning I can hunt down this item on the amortization table and try to say, okay, there it is. Let me do my comparisons based on that information. Or I could say, well, let's try to just kind of estimate it on a yearly basis. And this concept might be useful for other types of analysis as well, where you're trying to tie things out and do it a little bit more quickly. And so you might say, okay, let's do it on a year-by-year basis instead of a month-by-month basis. So this break-even was between 5 and 6 years. Let's take it out to 6 years and pull in our information from our table. Let's take the one with the points. Remember that the one that does not have points should still be around 5% for the life of the loan, due to the fact that when we look at that one, the amount of the $200,000 is the amount that's being the loan balance at the beginning, whereas over here we had a cash flow different than the loan balance. So that's what's going to result in this different rate over the life. So if we take the one with the points and we say, okay, what if I take the years here from my pivot table? And remember, the starting point represents 194, which that is the 200,000 we got. We can imagine ourselves receiving that from the loan company, getting financing from it, even though we didn't receive it actually, but you can imagine getting that money and then we paid it to the seller, but then minus 6,000 outflow that we had to pay also to the lender. So there's actually a net outflow or a net inflow here of the 194 that happened instead of the 200,000. That's where the twist comes in. And then we're going to say that we had, if there were points, and we summed up the payments, 11,807 on the payments each time period, which you can also calculate up top, which would simply be the payments of the 983.88 times 12. So we got yearly payments of 11,807 about. Now the next thing we would want to do is make sure at the end of this time period, we're going to say 6 years to start off with, we want to make the ending balance and see what the ending balance would be, because we'd have to pay it off at that point in time. So if we're looking at 6 years in terms of our table, which is down here, we're looking at the table to the right, and we're looking at the 6-year time frame. The ending balance then at that point would be the 177,447 plus the payments that we're going to make during that time period, which was the 11,807. So plus the 11,807. So in other words, we'd have to pay off the loan balance if we stopped at the end of 6 years and sold the property or something like that. The ending balance plus that payment that's going to be made in year 6, assuming we sell it at the end. This is what's not really taken into consideration so much with that prior calculation we looked at for the break even, because remember, these loan balances are going to be different due to the different interest rates as we go through. So that's where we're getting the 189,254. So if we stopped at year 6 and sold the property, we'd have the inflow up front, we'd have the yearly payments that we're assuming, and then this outflow at the end of the 189,254. If we were to sum up the positive minus the negatives, we get a net negative of 54,289. If we use our IRR calculation, which represents the rate at which this series of payments would be zero, we get to the 4.83%. 4.83. Now that's different than the rate up here when we looked at the effective rate, which was the 4.508. And it's different for two reasons. One is because we did a little bit of an estimate using the years, but two, because we didn't take it over the life of this thing over the 30-year time frame. So if I scroll down, we're looking for that to be closer to the 5%, because we would expect 5% to be on the side for the no, when you had the no points, and that would be kind of our break-even point at that time. So note the problem here, or one of the things that are going to throw it off a little bit, is because that 11,807, for example, is assumed to have happened all at the end of the year when we're calculating our IRR on a year-by-year basis. So if I'm looking at it on a year-by-year, it always represents the cash flows at the end of the period, in this case, a year, and that's where you get this little, slight difference due to the kind of rounding on that. If we took it on a month-by-month basis, then it would be more accurate. So those are the pros and cons of kind of trying to crunch it down into 30 years and summarizing it. If we did the same thing and we bring it up to 5 instead of 6 time periods, so now we got the 194,000 up top, and then our outflows of the 11,807 for 4 periods, and then in period 5, we'd have to pay off the loan balance. So after 5 years down here, we'd say, okay, here's the loan balance at that time, 181,615 plus the 11,807 for the payment that we had to make. Those two, that's going to be then the outflow of the 193,422. Adding those up, the net flow would be a net outflow of 46,650. And if we do the IRR calculation, the rate at which this series of payments would then be zero, we get a little bit closer to the 5%. So you would think this one would be a little bit closer at the 5-year rather than the 6-year here on basically the break-even point, because you would think you'd want that to be closer to the 5%. Now, just for comparison's sake, let's do the same thing for no points, if there were no points. Now, note, again, on the no points side of things, we had the same amount on the amortization table as the loan amount, meaning the effective rate was the same as the rate after points. Therefore, you would expect the IRR, in essence, to be equal throughout the whole time frame, generally. Now, we're not going to get to exactly 5% due to that rounding, so you can see the impact of the rounding looking at this in terms of years instead of in terms of months. So in other words, if we took the payments here, we've got the 200,000 and then the payments that are going out for the 5 periods on a yearly basis instead of a monthly basis, being that 12,884, which is the monthly amount times 12. And then after 5 periods, if we were to pay off the loan, we'd have to pay 183,657 plus the payments during that time period, 12884. That would be about 196,541. So if I was to then sum up this data, we'd have a net outflow of 4,877. 4,877 is different from this net outflow, 4,8077 minus 46650, of about 1,427. And then if I took the IRR, we get 4 of this series of numbers, the rate at which this series of numbers, which would be 0, which you would expect to be 5%, we get 4.96. And that should be due generally to the fact that we had the rounding that's going to be involved, the fact that we basically are assuming years instead of months, assuming that these payments happened all at the end of the period, in this case a year, when they actually happened in 12 equal payments throughout each of the years, giving us that difference in the rounding. Now, notice that we could have a difference in the total here, even at an equivalent IRR, because of the time value of money. So remember, that the $6,000 we put up front is worth more from a time value of money standpoint than the $6,000 you would get at a later point in time. So you could work these types of problems and just look at the cash flow and say, when exactly does the cash flow kind of work out, which is still a little bit tricky if you take into consideration the ending balance. And then you can also use your time value of money calculations, which might be a little bit more precise if you're taking into consideration time value of money, the fact that a payment up front is worth more than the payments that are going to happen at the end. And, time value of money calculations can take into account those kind of differences as well, resulting in having still a difference in the cash flow. But if there's a significant difference in when the cash flow happened, then you could have an equivalence kind of on the time value of money, taking that into consideration. So those are just some other tools. You could use these same kind of tools whenever you're doing any kind of comparison and you're trying to work with a lot of different comparisons possibly. You might consider putting them into a pivot table and possibly looking at them on a year-by-year basis, noting the pros and cons, the little bit less precise calculations compared to a little bit easier time of going through 30 periods if it's a 30-year loan as opposed to 360 period amortization table.